Reporting season ramping up here, as I said. Suncorp declaring, coming out this morning, declaring a special dividend and a $250 million on-market share buyback after a 42% pop in full-year cash earnings, driven by sharp increases in its insurance division. On the payout, big boost up to 40 cents a share compared to the pandemic impacted 10 cents last year, with a special dividend of 8 cents to boot. Looking ahead, headwinds remain with the company, saying while the operating environment has improved, the outlook remains uncertain, saying vaccinations are essential to reduce the frequency and the severity of lockdowns. David, what do you think of the result and the Suncorp share price at the moment?
That was a great result. That's certainly reflected in the share price today with that drop of just over 6%. The cash earnings was up 42%, and they announced that special dividend. So 40 cents fully franked div plus 8 cents special div. So they're across the board. Particularly their general insurance and banking was great. I think consensus for the result was 983 million. It came in at 1.06 billion. So that beat consensus. And, with the dividend yield now, with the extra dividend, excluding even the special, you're looking at a 6% fully franked yield and not overly expensive when you compare it in this sector, the banking sector, insurance sector. So I think there's more upside here. It's certainly a great result, and they're optimistic about their forecast going forward. But the general insurance premiums was also the one that really kicked it along.
Yeah. Would you be buying at these levels?
Yeah, I would be switching, actually, to tell you the truth. I'd be switching out of some of the banks into Suncorp, especially CBA. CBA reports this week. It better be good. It's expected it will be with some kind of capital management initiative. But, if you look at comparatively, okay, it's, CBA is the biggest bank, of course, in the sector, but 2% yield or 2.5% compared to 6% and 22 times earnings. I mean, I see more value in Suncorp. So for me, it's a switch.
Okay. Rob, what do you think of Suncorp and the result?
Yeah, look, the result was fantastic. Look, not that surprising, to be fair. We've been very bullish on the general insurance sector for some time now. In fact, anything that is to do with taking advantage of a rising yield curve should be an outperformer through this reporting season. I love the on-market buyback that they announced at 250 mil there. It really got into vogue back in the days when Robert Corlett was running Woolworths. Showed that was probably the best use of surplus capital for the long term to actually reduce the number of shares that are on issue. So in effect, everyone's piece of the pie gets bigger without doing anything. So love the fact that they've used that 250 mil there rather than trying to force an acquisition or just pay it out as extra dividends. It actually works better for you if they buy the shares back. Look, we wouldn't be buying it at these levels, despite the fact that you're getting a 5.4% dividend, even if you did buy it at these levels. We'd look for some kind of a pullback post, the announcement kind of getting out there and other people taking some of their position off the table. We'd prefer clients actually look at something like a QBE, just for the fact that they've got international exposure, where Suncorp is very much, with only Australia and New Zealand. So we want to have that US dollar exposure at the moment. So QBE for us at the moment over Suncorp, but yeah, fantastic result. We'd definitely keep holding it if we were in it, but we wouldn't rush out and buy it. We'd wait for a pullback before we bought into
it. David, just if you look at that good performance in insurance, can you leverage that to say, gee, if Suncorp did well in general insurance, then QBE and IAG must be doing it as well? Like Rob, Maitan Somasundaram from Deep Dive Analytics, he's been keen on the general insurers for, I reckon, about 4 or 5 months at the moment, saying they're so ugly that they actually look quite good.
Yeah, look, I agree with Rob there. Look, I like QBE, except that a lot of their income, their investment income, is driven by bonds, the bond yields, and at the moment they're very low. So if bond yields continue to move higher, that'll be very positive for QBE. So yes, in fact, of course, across the board, the general insurers, insurance generally, just premiums are going up, so that is positive in the space. But with QBE, it's mainly driven by their investment income as well. Like I said, the yield they're getting, which is not much at the moment, on bonds. So if that moves up, that'll give it a kick along as well. So I'd be watching bond yields very closely for leverage.